This week, Wall Street hit another all-time high. The Dow Jones Industrial Average surged to a record close above 50,000 points, even as geopolitical tensions, inflation risks, and global debt concerns continued building underneath the surface. And strangely enough, the biggest reason markets rallied wasn't explosive economic growth, it was collapsing oil prices. Because after months of fear surrounding Middle Eastern conflicts and disruptions to global shipping routes, investors suddenly became optimistic that diplomacy may prevent the worst-case scenario. And that raises a much bigger question: why are markets suddenly becoming optimistic again, while the global economy still looks increasingly unstable? Because underneath this rally, something much larger is happening. Banks are generating record profit. Artificial intelligence is rapidly reshaping infrastructure investment. Prediction markets are beginning to collide with financial regulation. And Europe is quietly warming about a future defined by debt pressure, cyber warfare, and economic fragmentation. This isn't just another stock market rally. It may be the beginning of a completely new economic phase. This week, the Dow Jones Industrial Average jumped nearly 200 points to close another historic high, and at the exact same time oil prices collapsed. U.S. crude plunged more than 5% after reports suggested diplomatic progress in stabilizing trade routes through the Strait of Hormuz. Now, on the surface, lower oil prices sound simple: cheaper gas, lower transportation costs, reduce inflation pressure. But in reality, oil prices influence almost every part of the global economy, because when oil rises aggressively, transportation becomes more expensive, shipping costs increase, manufacturing costs climb, and inflation spreads across the system. That forces central banks to keep interest rates higher for longer, which is why this recent decline in oil prices immediately boosted investor optimism. Markets essentially began pricing in the possibility that inflation pressures may cool faster than expected. But there's another reason this matters. The Strait of Hormuz is one of the most strategically important shipping routes in the world. A massive percentage of global energy flows directly through that corridor, and over the last several months, investors have been increasingly worried that any escalation in the region could create a severe supply shock. So when signs of stabilization appeared, markets reacted immediately. But while falling oil prices helped push stocks higher, there's another reason Wall Street remains surprisingly resilient right now. The banking system is still generating enormous profits. This week, some of Canada's largest financial institutions delivered stronger than expected earnings. The Bank of Montreal reported quarterly profits of more than $2.6 billion and announced a dividend increase. National Bank also outperformed analyst expectations. And this is important because banks sit at the center of the economy. They see consumer spending, business borrowing, mortgage demand, credit stress, and investment activity all in real time, which means strong banking earnings often signal something deeper about the health of the financial system. Right now, despite high interest rates and slowing consumer activity in some sectors, banks are still managing to generate strong revenue. And one reason is simple: higher interest rates can actually improve profit margins for larger financial institutions. But there's another side to the story. Even though banks remain profitable, many consumers are still under pressure. Debt servicing costs remain elevated. Housing affordability continues to deteriorate, and businesses are becoming more cautious with expansion plans. So the market is entering a strange position. Financial institutions appear stable, while the broader economy still shows signs of stress underneath the surface. And that same contraction is starting to appear inside the technology sector as well, because investors are no longer simply chasing software companies. They're now aggressively moving into AI infrastructure. Over the past year, most investors viewed artificial intelligence as a software revolution. Chatbots, automation, productivity tools. But increasingly, Wall Street is realizing AI may actually become an infrastructure business, and that shift is becoming enormous for markets. This week, semiconductor companies continued surging as memory shortages and AI data center demand pushed valuations to historic levels. Micron Technology recently approached a $1 trillion market capitalization, driven largely by growing demand for memory chips required to power generative AI systems. And this changes the entire structure of the market, because now investors are rotating shifting capital away from traditional software and toward the physical system required to power artificial intelligence. That means chips, energy, cooling systems, data centers, and electrical infrastructure. In other words, AI is no longer just a digital trend. It's becoming an industrial build-out. And industrial build-outs require enormous amounts of capital, which creates another major issue for the global economy, because the building of AI infrastructure at this scale becomes much harder in an environment where borrowing costs remain elevated. This is why interest rates still matter so much to technology markets. The AI boom now depends not only on innovation but on financing conditions, energy stability, and geopolitical cooperation. And as money floods into these rapidly evolving systems, financial regulations are starting to struggle keeping pace. This week, the federal prosecutors charged a Google employee in connection with insider trading allegations tied to prediction market wagers placed through Polymarket. According to investigators, the employee allegedly used private, non-public information to place a highly profitable bet. Now, on the surface, this sounds like a standard insider trading story, but the implications are much larger, because prediction markets represent a rapidly emerging part of the financial system. Platforms like Polymarket allow users to speculate on elections, economic events, geopolitical outcomes, and even global conflicts. And increasingly, these platforms are beginning to resemble financial exchanges more than simply betting websites, which creates a major regulatory challenge, because governments are now trying to determine where prediction markets fit inside the modern financial system. Are they gambling platforms, information markets, financial derivatives, something entirely new? And this is becoming exceptionally important because artificial intelligence is dramatically increasing the speed at which information moves through markets. Financial systems are evolving faster than regulation can adapt, and according to Europe's central banks, that may become one of the defining economic risks of the next decade. This week, the European Central Bank released a report warning that the persistent geopolitical tensions and trade fragmentation could create serious long-term risks for economic growth across Europe. The report highlighted concerns surrounding rising borrowing costs, budget sustainability, slowing GDP growth, and growing infrastructure vulnerabilities. But one detail stood out in particular. European officials specifically warned about the increasing threat of AI-driven cyber attacks targeting financial networks and critical infrastructure. And that tells us something important. Global economies are beginning to realize that artificial intelligence is not simply an economic opportunity, but it's also becoming a national security issue, because the same systems powering productivity and automation can also be used to disrupt financial institutions, power grids, communication networks, and supply chains, which means governments may soon be forced to spend massive amounts of money hardening infrastructure against technological threats. And that creates another layer of pressure on already strained budgets. Especially in heavily indebted economies. So when you combine everything happening right now, the picture becomes much clearer. Markets are rallying because investors believe inflation pressure may temporarily ease. But underneath that optimism, the global economy is becoming more dependent on AI infrastructure, energy stability, debt financing, and geopolitical cooperation. And all four of those systems remain fragile. So while Wall Street may be celebrating new all-time highs, the global economy is entering a much more complicated phase. Artificial intelligence is rapidly transforming infrastructure investment, banks remaining profitable despite economic pressure, prediction markets are challenging financial regulation, and governments around the world are preparing for a future where technology, energy, and geopolitics become deeply interconnected. This is no longer a normal market cycle. And over the next few years, the biggest opportunities and the biggest risks may come from understanding how all these systems connect together. If you enjoyed this video, make sure to subscribe and leave a like to support the channel. Breaking Bank is still growing, and the goal here is simple: to break down the biggest economic and financial stories shaping the world and explaining what's really happening underneath the headlines.